What is good, Tesla family? It's Ray J back with another video, and in this one, I'm going to give you guys an update on what I should be expecting for Tesla stock, what on earth the rate hikes may end up doing, where Tesla may get its bounce on Monday, and what you should be anticipating for the share price going into the future. Now, before I talk about any of this, before I do any technical analysis and talk about our economy going forward, I do have to mention a couple of very important things. The first thing is I'm not a financial planner, so please do not take this as financial advice. And also, if you guys can, please smash the like button if you want to see more videos like this. It not only benefits me, it benefits the entire Tesla community as a whole. And the last thing is, if you guys can, please check out the Moomoo link down below and in the description. If you do sign up for Moomoo and deposit $100, you're not only going to qualify for up to 5 free stocks, each worth up to $3,500, but you're also going to get a free Neo share. So if you want this opportunity to get a free Neo share, check out the link down below. With that out of the way, let's get on with the video. So looking at Tesla, we did have a red day on Friday. We ended up dropping a little bit harder than many of us had anticipated. And now I do want to talk about what could end up happening, because the thing is, many technical indicators are suggesting that we're not necessarily at that bottom just yet. We could end up dipping a little bit more going into Monday. So I want to actually talk about where I see that going. So here's the thing that's on everyone's minds right now. We have a pivotal week ahead of us. And the reason for that is because of what the Federal Reserve is probably going to end up doing. They're expected to raise interest rates. And many people are saying, because of the fact that we have this Ukraine crisis also adding volatility, it's going to affect their actual monetary policies. So I'm going to actually review what this interest rate change means, why they're doing this, and look at this from an economist lens. So a hike in the Fed's rate, it's immediately going to lead to a jump in the prime rate. And what they're doing is they're raising the federal funds rate. The federal funds rate is basically the cost to borrow money for banks. So the way banks make money is they're taking money from people, right? People put their monies in banks, and these banks basically pay people some interest. But in order for them to make money, when they loan out money, they have to charge interest too, but they charge even more interest than what they pay people. So what's happening is, when the Fed, the central bank of the USA, when they start raising the federal funds rates, that's going to cause banks to, it's going to be more expensive for banks to borrow money. So what happens is the banks start charging people more if a person wants to take out a loan. And when they start doing, it leads to this domino effect that essentially or theoretically is going to slow down our economy. So you're probably wondering, okay, why would they want to slow down our economy? Well, the thing about that is, a healthy economy cannot be exploding way too fast. Rates of inflation represent many things. Cars have different rates. I would say houses, assets, they tend to have different rates of appreciation. So the way inflation works is, you want to have a steady rate. Uh, Around a 2 to 2.5% rate would be the average, and that's what we want. Now, there were times where we actually had lower rates of inflation over the last few years or so, but so right now, even if inflation was around 3%, that wouldn't be too bad. But it's estimated to be around 7.9% based off CPI data. PCE data also shows a very similar number, and they are running at a faster rate than people want. So now we want to slow down our economy to give more stability. So what this is theoretically going to do is de-incentivize people to take out these loans, de-incentivize spending in a way, and them raising rates may even lead to a recession. But just because there's a recession, remember guys, just because there's a recession, it doesn't mean the market has to crash really hard. We could see a correction, maybe a significant correction, but it doesn't have to lead to a 2008 style or Great Depression style crash. We've had recessions for the past century or so, right? We've seen them over and over again. Not every recession causes the market to even crash really hard. So there have been recessions in the past that caused the market to dip a little bit and then recover quickly. And from the way I see it, it's very hard for me to make that call going into the long-term future, because there's so many factors at play here. I don't know what's going to really play out with the Ukraine situation. I don't know how the Fed is really going to respond, but going into what the Fed is doing, they have the FOMC meeting. So they have a big meeting. They're going to be announcing rate hikes perhaps on Tuesday or Wednesday. I don't truly know the exact dates, but it's going to come early next week. I have to prepare you guys for that. So going into next week, prepare for insane volatility. We're probably going to see a lot of swings when Jerome Powell, who is the chairman of the Fed, when he starts talking, the market could sometimes just drop all of a sudden, then all of a sudden run right back up, depending on what he announces, because the Fed, it doesn't seem to be very certain about exactly how they're going about this. If I'm going to be real with you, it low key feels like they're almost winging it. And I'm saying that because they probably would have raised rates by 50 basis points considering how serious inflation is getting. And that would have caused the market to be hit really hard. But now it's looking more like a 25 basis point hike. So a 0.25% hike, which is not going to affect the market too badly. And the reason why they're changing is because so much went down over the last couple of weeks, right? And if you look at what's happening in Russia, all these big investors, these massive companies like BlackRock, invested in these Russian companies. They're losing billions of dollars. They lost so much money as the US is now cutting Russia off of our economy. They're getting cut off the international banks. It's hurting them. So where I'm going with this is this. There's lots of uncertainty, and even though I can make predictions, I will tell you what I want you guys to expect, but it's going to be tricky to be perfect because there's so much going down, right? There's so much going down. So going into next week, or I'm sorry, by next week, I mean Monday, this is what I think. If we do end up descending, we're going to have support. We have some support at 795. I don't think that's going to hold too well. Right now, technical indicators are suggesting we haven't found that bottom yet. So I would anticipate, considering the fact that the $800 level of support did not hold, we're going to retrace probably. And there are three lines I think we're going to find a bounce at. We're either going to go down to 780 to 782 and bounce off there. If that doesn't hold up, which is totally possible, we're probably going to get a bounce at 771. But I do think 780 is going to be a little bit more probable because the last time we did bounce off that, it does kind of form like a double bottom like formation. But those are the key levels of support you have to be holding out for. And I don't see us dipping much lower than that because it's very dependent on so many factors. So it's really hard to call. But for Monday, I do expect us to test these levels of support. We're probably going to bounce up a little bit and just kind of trade kind of sideways with insane volatility because we're still waiting on what's going to be announced, right? That's the main thing. We're on the edge right now. We're waiting for what the Fed ends up doing. And it's not just about to what degree they're raising rates, it's also their monetary policy. It's also about how many times are they going to raise rates? Is it going to be two more hikes, three more hikes, five more hikes, 10 more hikes? I don't really know. We don't truly know. And it's really up to what the Fed really announces that's going to affect Tesla. So I want to wait for that. Besides that, just be prepared, guys. High volatility. We do have support once again, 795, 781 to 782, and as low as 771. Those are the three major levels that we should be possibly going to. I do think it's more probable we're going to bounce off 782. So we'll just wait for that. Now, once the announcements are made, once, let's just say hypothetically, the Fed raises rates by 0.25%, right? It's a small hike. It's not going to affect the market too much, but as long as they don't make any other insane announcements, we're going to be fine. And we may even start to run in the green after that. I do think that's a little bit more probable because Jerome Powell is known for being more on the dovish side, which means that he doesn't want to crash the market too hard. He tends to be a little bit less strict when it comes to his policies. So we're just going to have to wait for that. Like I said, we'll see how it goes. But going into Monday, I do expect us to drop a little bit. And I showed you guys the levels of retracement. So be prepared for that. But remember, long term, we're still very bullish. It does not matter. This is just a little, trial that Tesla's going through, a little mountain we have to cross. We're eventually going to get past it. We're eventually going to break all-time highs in the future. So remain calm, cool, and collected. And I will see you guys in the next one. Enjoy the rest of the weekend and peace out.